What if the market is ignoring the most dangerous setup possible right now? Inflation is not really cooling, oil is rising again. Treasury yields are moving higher, the dollar is strengthening, and yet a huge part of the market is still acting like nothing is seriously wrong. In this video, I'm going to show you why the latest inflation data did not calm investors, why oil may be the real trigger to watch, and why the combination of rising energy prices, slowing growth, and sticky inflation could become a major problem for stocks. Because if this setup continues, we may not be looking at a normal pullback anymore, we may be looking at the early stage of something much bigger. Let's start with the market action. On the surface, the session looked fairly calm. The Nasdaq finished slightly higher. The S&P 500 was basically flat, but the Dow and the Russell took a more noticeable hit. That matters. Because when the major indexes look stable on the surface, but weakness starts showing up underneath, that is often an early warning sign. The VIX was actually down on the day, but it remains elevated. The S&P 500 is still below the 6,800 level. And most importantly, the market did not get any real relief from inflation data that came in exactly as expected. That is a problem. Because when markets stop reacting positively to good enough news, it often means the trend is getting tired. Now let's talk about inflation. Headline CPI came in at 2.4% year over year, exactly as expected. Core CPI also matched expectations at 2.5%. And both numbers were unchanged from the previous reading. On paper, that sounds fine. No upside surprise, no reason for panic. But the market barely cared, and that is where things get interesting, because even though CPI did not surprise to the upside, producer inflation has already been running hotter in recent reports. That means pricing pressure is still there in the system. It just has not fully shown up yet in consumer inflation. And now you add oil to the equation, if crude stays elevated or moves higher. That pressure starts spreading through the economy. Gasoline, shipping, transportation, input costs, consumer budgets. So yes, CPI looked stable. But that stability may turn out to be temporary rather than reassuring. And this brings us to the real issue. The biggest risk right now is stagflation. The biggest risk right now is not just inflation, it is stagflation. That means slower growth, weaker demand, but inflation that stays too high. This is one of the worst macro setups for markets. Why? Because in a normal recession, the Fed can usually cut rates aggressively. In a normal inflation scare, the economy may be strong, but in stagflation, you get the worst of both worlds. Growth weakens, prices stay elevated. The market is now watching the revised GDP number very closely. Expectations are around 1.5% after the prior reading of 1.4%. But the real story is not just the number itself, it is the trend. Earlier growth estimates had been much higher. Some were above 5%. Actual result was weaker. So if GDP comes in weak again, or worse, if growth deteriorates further, then the stagflation conversation becomes much louder. At the same time, we get PCE data. And if PCE stays sticky while growth weakens, then the market is forced to confront a very uncomfortable reality, inflation that refuses to cool. Now, let's talk about the most explosive part of this story, oil and geopolitics. Crude oil jumped roughly 5.5% in the session. That is a move the market has to respect. And oil is no longer just a commodity story. It is now directly tied to inflation, consumer spending, shipping costs, and global growth. At the center of this issue is the Strait of Hormuz, one of the most important energy choke points in the world. If tension rises, prices will spike. The market does not need a full shutdown of supply to panic. Sometimes the fear of disruption is enough. That fear alone can create a risk premium. Now let's look at the technical picture. Crude had a powerful move higher, then pulled back, tested the moving average, and bounced again. Oil does not look broken. Now let's move to Treasury yields. The 10-year yield is climbing again, and that is another problem for stocks. Higher yields mean tighter financial conditions. More expensive borrowing, valuation pressure on equities, especially tech, and more stress on the broader system. The market loves the soft landing idea. Now, let's talk about the US dollar. The chart is telling a very different story. The dollar looks like it may have already bottomed and is pushing higher. That matters because a stronger dollar tends to pressure risk assets. When it rises alongside yields, that is an especially difficult combination for equities. Nvidia remains one of the most important stocks to watch. If Nvidia starts breaking down decisively, that could put serious pressure on the broader NASDAQ. The bigger issue is that the market structure looks fragile. Indexes are diverging, breakouts are failing, and more charts look like distribution. That is how tops often form. Most investors say, well, it hasn't crashed, so things must be okay. But this mindset is exactly what makes this stage so dangerous. Tops rarely begin with panic. Meanwhile, institutions may already be reducing exposure, rotating defensively, or preparing for a much more aggressive move. This is how investors get trapped. So where does that leave us? Inflation didn't improve. Oil is rising. GDP and PCE could intensify fears. The stock market looks weaker beneath the surface. Before we finish, a quick reminder. This content is for educational purposes only and does not constitute personal financial advice. Always do your own research. This is the time to pay attention. Subscribe to the channel for more macro breakdowns. Let me know in the comments, what is the biggest trigger, oil, yields, or GDP?